want to welcome everybody. I'm going to do the introductions. And before we get going too much, what I would love is if anyone can pop into the chat and tell us what they see right now on their screen. Who's talking? Well, whose face do you see?
All four of us are right now on there.
Okay, so perfect. Okay. So tonight we have three industry experts that are coming to us to talk to us about finance. And tonight you're going to watch me read from notes because I want to make sure I get these introductions right. And I believe the order is Marcy, Sean, and then Corey, correct? All right. So Marcy is a strategic business and finance coach who's been an entrepreneur for over 20 years. She's worked in multiple industries, including real estate, business. She's been a business and marketing consultant for various small businesses. She's been a leasing manager at Toyota Motor Sales and a financial educator for the World Financial Group. Today, she's going to talk to us about her model for building a strong financial foundation. And as you guys know, that's what we've been talking about so far every week is the importance of the foundation. So she's going to cover strong financial foundation, just like in architecture. And I feel like we just switched something because now I'm seeing Corey's face instead of mine.
We can see you.
Well,
I'm working on that while you're going through it so that whoever's hosting is going to be the only one showing.
Okay. All right. So in the same way as you build your business and your empires, it's important to first address your foundation, as we learned in week one when you thought about building a house. So today, Marcy's going to give us some key foundational concepts that you can apply towards your business and your life, because I believe there is a saying that your financial health in your personal life pretty much correlates to your financial health in your business life. All right. And then we have Sean. Sean is a certified internal auditor and an enrolled agent who's been involved in various facets of accounting and sales for over 30 years. Okay, so don't let that word auditor scare you guys. Sean is amazing. He's worked in multiple industries, including commercial printing, where he owned his own print shop, and after for 4 years, and then he sold it, and the accounting department of he sold it to the accounting department of billionaire Glenn Taylor. Is Glenn Taylor the owner of the Wolves, the Timberwolves? Yep. All right. That's what I thought. Minnesota knowledge. Woo woo. He's also had done accounting and sales for various small businesses, real estate, construction, and farm management. He's been the North American sales manager in the whey protein division of Davisco Foods International, and he's currently providing tax prep and planning for 325 clients, as well as managing rental properties. And we can tell you Sean is amazing. We can personally tell you that because Sean is our accountant for SB Pace. And we've never seen anybody who sends more information out to help us to make sure we're staying on track from a tax perspective. Today, Sean's going to be talking with us about some actionable info to build out your cash flow and budget. Just like in concrete, you need good base material before you pour a strong foundation. Managing cash flow is a key element to your success. Today, Sean will give you a framework and steps to help you control your financial future. He's amazing. He makes things super simple to understand. So does Marcy. So you're going to really enjoy these conversations. We encourage you. Make sure today, it's especially important if you have questions, that you're entering them in the Q&A as you think of them, but put the name or the first initial of the person who the question is for, because these are all financial today. We're covering everything financial. So we want to make sure we know who you're asking. And finally, we have our expert, Corey. And Corey will be covering cost benefit analysis.
Basically, yeah.
Yeah. So, and y'all know Corey, so I'm not going to do any bigger introduction than he is the finance guy behind SB Pace. He's in charge of our revenue, and he tells me when I'm spending too much money, and he is the person that determines if I get paid or not. So mad respect to all three of them. You guys are going to love this, and let's get started.
Perfect. So for those of you who don't know me, my name is Marcy Liu. And as Julie mentioned, I am an entrepreneur. I've been an entrepreneur ever since fresh out of high school. I didn't do the whole college thing. I didn't do degrees or anything like that. And I've tripped and fell on my face numerous times, and I've learned as a result of it. And I think today, just looking at the climate of how business is, and there's a huge shift in the mindset with COVID and a lot of people getting laid off, understanding now that the things that we've been told growing up, like go to school, get a good job, you're going to have security, those are no longer true. So I wanted to bring to you kind of like a 30,000 view of how I learned about finance and how I learned how to put everything together. I got into real estate back in the early 2000s when the market was booming, everything was great. I was in my early 20s and I'm just like green behind the ears. I have no understanding of how, like I had just bombed on a major investment in a martial arts school. Fresh out of high school, I did martial arts and I opened and I closed it very quickly. I lost about $200,000. And my exposure into financial literacy was really when I got into Keller Williams. That was my first experience of having millionaire mentors, of people that were really successful, that weren't looking to get anything out of me necessarily, but it was just a culture of giving and sharing information and helping the next generation grow. Fast forward, in 2016, I was working for Toyota. And of course, we know 2008, 2009, there was a huge recession. A lot of people lost their jobs. It's very similar to what we're experiencing now. But you fast forward from 2008 all the way to 2016, and I'm working in the leasing department. I'm helping people getting out of their old car or leasing contracts. Maybe somebody has a Corolla, maybe they have a Prius, and they have a new addition to the family, or they got into a different line of work and they need a larger vehicle. And I was helping them to restructure their contract so that they could get something that they needed. But the thing that was really shocking to me is you see people that, doctors, nurses, like high paid individuals that making anywhere from $90,000 to $100,000 a year, coming in and not being able to get approved for a vehicle because back in 2008, maybe they had a business and maybe they were not educated on credit and they went through bankruptcy and they just never rebuilt it. And with that experience and looking really at, okay, when I got into real estate and I got into business, I thought I had no experience with finances, but then going forward and seeing all these professionals that were like supposed to be knowledgeable and they were struggling with some very, very basic issues, that really spawned me to delve deeper into education. I was introduced to World Financial Group in 2013, and World Financial Group is first and foremost an education company. So I'm going to share with you, hold on, let me do this real quick, pull up my PowerPoint. This is my information. You guys can take a screenshot. I'll post it again at the end. But World Financial Group, we teach 6 financial foundations to build, basic security and financial independence. I'm going to go through these from the standpoint of an individual, because I believe that if you don't know how to manage your individual finances, that those mistakes that you're making individually are going to translate into your business world. So on the individual side, we look at cash flow, and normally people have an income from their job, and every single dollar that's coming in is either going towards their living expense, to taxes, to, discretionary income. And of course, a lot of people have debt. So we look at cash flow, how much is coming in, and we look at how much money they owe. And we find a balance on how to get them out of debt. We set in place a plan for proper protection, because if you think about like a 2-income family, and all of a sudden something like COVID hits and one or both of the income earners are no longer able to bring in money, what happens to the financial household? It falls down, right? Or we also look at if somebody gets sick, or worst case scenario, if somebody passes away. So we want to make sure that we address the protection aspect for these families. We make sure that people have enough in reserves for an emergency fund. Now, traditionally, emergency funds, we're taught to save 3 to 6 months of our living expenses. Of course, with COVID, with quarantine, we know that 6 months is actually not enough. So we advise people to look more towards 12 months. And I'll show you how all of these translate into business. And then of course, once you have this foundation set, we want to take the money that is coming in, show you how to grow and how to multiply it. And at the very end, if you've done all 5 steps correctly and you've amassed a sizable amount of wealth, you want to be able to pass it on to your next generation with minimal input from the government. So today, because I only have a limited amount of time and this is a lot of information, I do want to ask your forgiveness because I'm going to go kind of fast, and I'm also not going to cover everything. Okay, we're going to talk about cash flow. And of course, Sean's going to go deeper into cash flow because it is so very important in business. I'm going to talk about debt because I think a lot of people leverage debt in a way that can be detrimental if you don't really understand the impact and the cost of borrowing money. I'm going to touch on protection because insurance as an industry is something that a lot of people shy away from. And I want to make you aware of some of the different types of insurances that you can leverage to build your business and your wealth. I'm going to skip emergency funds because that kind of goes in with cash flow. And we're going to talk about growth and accumulation. Now, if I have enough time at the end of the session, I'll touch on retirement and some exit strategies. Of course, estate and wealth planning preservation, I just want to mention really quickly that really this is something that you want to sit down with a professional because we get into formulation of entities, corporations, trusts, all those type of things that I'm not going to have the expertise or the time to get into today. So the first step in building a strong financial foundation is really cash flow. Normally, as I mentioned, this is a personal, budget sheet. Every single dollar that's coming in, you have to cover your living expenses. Uncle Sam takes his cut. Whatever isn't going towards debt, statistically, Americans are saving less than 1%. If we look at it from the business point of view, there are different allocations that you have to take into advisement if you're looking at business expenses. But today, what I'd like for you to be able to do is shift it not from personal or business, but look at it as a combined thing. Because ultimately, when you're starting a business, you still have to live, you still have to pay your bills on your business side, but you want to make sure that everything has a place in a budget. Now, I'm going to give you a riddle. Imagine you're a single parent. And for whatever reason, you have financial hardship, you have 2 young kids, and all you can afford is 2 slices of pizza. Most people, when they look at this riddle, they would say, well, of course, each kid would get a slice of pizza. But today, I want you to think about it in terms of when you go on an airplane, they say, put the mask on you first. If you're the adult, you're the single parent, and you're the one who's bringing money in, and you give the pizza to the kids and you're not eating, it's only going to be so long until you can't produce anymore. So the proper way to do it is you want to pay yourself first. You get a full slice and the 2 young kids each get to split a slice. Okay. So if this is every single dollar that comes in, what I would suggest is put money aside for taxes up front. It's may or may not be 15%, but in my experience with business expenses and things that you can deduct and all of these different things, you get to settle the rest of it at the end of the year or at the end of each quarter. If you have money set aside for taxes, it alleviates so much stress. The next thing you want to do is you want to take 10% of the remaining and set it aside for yourself. So you're paying yourself first. Then out of the remainder, which is about 76%, you get to split that up between your operating costs, which is your living expenses and your base business expenses. And then the profit gets further split up. And this is just an idea. I mean, obviously the allocation is going to be different on a case-by-case basis, but you want to look at marketing and you want to have funds that you can reinvest into the business that can be either having reserves in case money's not coming in fast enough that you can sustain the business. You have capital in case there's a great opportunity. Let's say there's a sale on raw supplies or there's a opportunity to grab up another business merger, whatever the case is. You have money set aside for research, for scaling, and of course to repay it back your debt and any kind of investors. I didn't want to get too deep into that because I know Sean's going to deep dive into that. But the second step is if you have all of those allocated and you don't have enough money coming in still to function either on your living or your business side, then you start looking at borrowing money. Some different ways that you can borrow is everybody has access to credit cards. There's lines of credit, whether it's a business line or a home equity line. There's loans, either personal loans, small business loans, etc. You can get capital from investors. And of course, if you're working with vendors, sometimes they will extend credit to you that you can hold a balance. Here is what I really, really want you to think about. When you're borrowing money, there's a cost associated with it. And most people, they don't really understand the math behind it. So I want to share with you the rule of 72. Albert Einstein figured out this is the algorithm. If you have compounding interest, how long it takes for that money to double. Now, this can be applied either on the growth side if you're investing, or of course, today we're talking about on the borrowing side. This is the cost. So the way it works is you take whatever the APR is, the interest rate, the annual percentage interest rate, and you divide it into 72. Why 72? That's just the way it works out mathematically. And whatever that number comes out to is the time it's going to take in years for the money to double. So for example, if you have 1%, you're dividing it into 72, it's going to take 72 years to double. If you have 4% divided into 72, it's 18 years. What does that look like? If you borrow $20,000 and you're, let's just say, not making any kind of interest or minimum payments on it, in 5 years, that 4% loan is going to end up being about $24,400. Okay. In 10 years, it's 29, almost $30,000. But look at these rates. Okay. This is great if you're looking at something like a car loan, a mortgage loan, etc. That's pretty reasonable. But if you're looking at credit cards statistically, I know when I first started in business, it was like, oh, you have a 0% APR for 18 months, but it's a 4% fee. So right off the bat, it's 4% to borrow. And then after the 18 months of no interest, it all of a sudden jumps up to like 22%. So that 22% loan takes 3 years and 5 weeks for it to double. If I borrow $20,000 in 5 years, that amount would end up being almost $60,000. And in 10 years, I don't even know what I'm going to do with that. So thinking about that, and you guys can screenshot this because I think this is something really important that most of us were not exposed to. You want to really hold the money that you're spending accountable. You want to understand the difference between what is an expense and what is an investment. So Robert Kiyosaki talks about liabilities and assets, and expense and liability basically is anything that pulls and drains from your wealth. And investments and asset is anything that you might be leveraging that's going to pay back in. And I put the stop, the stop in the walking sign because there's a concept called red light, green light. So if you have an expense or if you have a budget to spend on something, let's just say, for example, advertising. And let's say you have $1,000 budget and you're going to make that $1,000 last over the course of the next 6 weeks or 6 months. You don't want to throw all of that in and be like, well, if it works, great. And if it doesn't, then I'm going to have to go borrow more money. The red light, green light concept is basically like, okay, if I have $1,000, I'm going to break it up. I might start with a $200 test. And out of that test, and within a week, if I'm doing digital marketing or pay-per-click ads, I'm going to say, okay, what is working? I'm going to throw more money into. What isn't working, I'm going to pull back and redirect. And if you look at your budgets in this way, and you look at all the different ways you're spending money and you hold it accountable, then it makes more sense if you are paying these astronomical interest rates to borrow the money, because ultimately you're paying into your business and you're investing because the business is an asset that's going to pay you back. Okay, so the next step in our foundational principles is proper protection. Now, if you think about protection in the standpoint of like something bad's going to happen, how do I minimize risk? We think about it in terms of I'm working hard to create revenue. I'm working hard to create a business that's going to give me profit. if I'm going to protect against something bad happening, I need to be aware of what can be taken away. What is cost that I may not be accounting for. Fees, starting out, bank fees, credit card fees, little fees here and there, it drains from the account. You want to be aware of that. Inflation, looking long-term, statistically, I mean, if it's a 3% inflation rate, which it is here in California, it's going to take 24 years for the buying power or the cost of living to double, or rather my buying power to be diminished by half. So if I'm creating income and I'm creating profit pools and I'm trying to project that out long-term, I need to be aware that inflation and the rising cost of goods is going to affect my profits long-term. Market fluctuations. This could be anything from turn in trends. Let's say the craze right now is food trucks, and all of a sudden people don't want to eat out anymore because food is being contaminated, and all of a sudden 100% of your business is shut down because you can't operate a food truck. So that's something you want to be aware of. Taxes, of course, there's effect of taxes on your profits. It's not something you can necessarily predict because every single year the tax rates change, but sitting down with a professional and planning it out long term, you can really prevent unexpected downfall and an unexpected risk from not properly planning for your taxes. Now, another thing that people really overlook is opportunity cost, the cost of waiting, and also disruption in business activities. So disruption in business activities is something that you can definitely address by insurance. I took these definitions from Investopedia. And the idea of insurance is to indemnify a situation and to protect yourself against risk so that somebody else is taking in the hit and you can return back to the original state. Okay, so indemnify is basically to compensate or to secure against legal liability. Different types of insurances that you may or may not be paying into and you may or may not be aware is even available. Business liability insurance, I think everybody has that. That's in case, let's say you have a storefront, somebody trips and falls, they sue you, you have liability protection. You have property insurance in case there's a fire or a flood or a riot that the insurance company will pay to recompensate you. Health insurance in case you get sick. Disability insurance, if you can't work, there's still cash flow coming into the business. Disability and long-term care are very similar in the sense that if you're unable to work, that there is a replacement of some kind of income stream or revenue stream. Now, buy-sell insurance, key person insurance, these are both life insurance policies that if you're building a larger corporation or a larger infrastructure, you might want to take a look at this because let's say you have 3 partners or you have, in the case of Apple, like Steve Jobs. Steve Jobs was vital to Apple being successful. He was the one who's the visionary, and happened to, of course, the Apple company took a huge hit at that time. So the buy-sell insurance is basically if you have, let's just say 3 partners and one of them passes away or is unable to work, the insurance on that person buys out the interest for that family so that the controlling partners are not disrupted because all of a sudden heirs come in and they want to tear apart the company or whatever. The key person insurance is the same idea of, let's say you have a key person, a key employee or a key partner that is vital to your business, and they themselves are responsible for 80% of your production. If something happens to them, the entire business falls down. So you can leverage life insurance to basically offset that risk, that if for whatever reason that amount that they're bringing in isn't able to come in because either they pass away or they can't work medically or whatever, that there is a lump sum that can sustain the business. And then life insurance retirement plans is definitely something that the larger corporations use. And I'll touch on this more when I talk about retirement planning, but basically we're leveraging cash accumulating life insurance plans so that you can build different assets that you can pull from in the future. There's access to that cash. It's liquid. You can use it for retirement. You can use it to compensate as benefits for your key employees, different ideas. Okay, now growth and accumulation. I think everybody really, really wants to know how to grow the money. If you start a business and you're a self-employed individual, the idea is you got into business because you wanted to control your own life. You wanted to not have a ceiling that, you know, some corporations, there's only so much that you can grow. I want to expose you guys. If you haven't seen this, this is the cash flow quadrant. This comes from Robert Kiyosaki, and the idea is there are 4 different sectors of community of how to make money and where money comes from. Majority of the population is employees, where you work, you get paid. You have a boss and you have to show up to work. And over here, this is the prime example of trading time for money. When you start out and you start your own business, now you're still working for money, but you're working for a profit. And if there is no profit, you actually don't get paid. But the trade-off for that is you have flexibility, you have freedom, you can have, you know, creative ideas and however you want to build your business. And once the company does become profitable, there's no limit to what you can make. However, because you are working for yourself, if you don't show up and you're not working, let's say you wanted to take a 6-week vacation, then you wouldn't be making money during that time. What you want to actually think about when you're thinking about growing and accumulating wealth is to move away from trading time for money, and you want to become a business owner. And the way that Tony Robbins describes this is the difference between an owner versus an operator. An operator has to show up. The operator, the business is hinging on their involvement. The owner is able to leverage the work and the efforts of other people. They're leveraging their money to create more money. And ultimately, there is a system of duplication that the business owner can walk away for, you know, maybe a few weeks or a few months or a few years at a time, where the money is still coming in and the business is still growing. And then, of course, whatever profits that you have, you want to be able to leverage that as an investor to grow more capital and to grow more profits. Here's another idea. When you're thinking about branching off and you're creating multiple streams of income, I mean, that's like the catchphrase. Everybody wants multiple streams of income, right? The example is, let's just say you have a shoe store. You know, it could be fashion shoes, it could be sports shoes, it can be whatever, but you have a shoe store. And as you're selling shoes, and let's say you want to scale and you want to expand your business, a logical expansion would be maybe you start selling shoelaces, or you start selling cleaning supplies for the shoes, or you start selling, you know, all these cute little accessories that come with shoes. And then maybe you'll branch off and you're like, well, if your high heels get scuffed up, or, you know, the leather on the boots aren't shined or whatever, then they can bring it back and get shoe repair. When people think of multiple streams of income, this is what not to do. You have a shoe store and then you branch off and you're like, I have extra money, I'm going to go open a food truck. What you really do want to branch off is you want to take, like, okay, let's say the shoe store is your main source of income. You don't want to mess with your mainstream of income. You don't want to divert your focus so much that it's like, okay, well, now you're putting all of your energy to bring a food truck, which is something completely in a different industry. You might want to branch off and say, well, I'll do a clothing store. You know, I have fashion shoes, I have the accessories that go with it. Maybe I'm going to do handbags, and I'm going to do belts and sunglasses or something like that. So when you start branching off and you have extra, as your revenue is increasing and you have extra money to invest back into the business, maybe you hit a certain level at the shoe store. Maybe you start branching off and multiplying multiple locations, multiple shoe stores, multiple places, but then you have so many people coming in and they're asking for the accessories that you can branch off and say, hey, this is the alternate way that I'm branching off in the vertical. Okay, so when you are building your business, some key things to keep in mind is you want to build it in a way where you are following systems, or you're creating systems for other people to follow. That way it's duplicatable and you can delegate it for somebody else. You definitely want to hire help, whether it's basic employees or you want to hire somebody that's a professional that specializes in areas that you may not necessarily know or be proficient at or have interest in doing. And as you're hiring and you're building out your organization, you want to have leaders that come up to kind of take your place. So you're hiring people to replace you so that you can go a step higher and you can grow into a bigger organization. You want to create your multiple streams of income and you want to do it in a way that makes sense so that you're not diverting your attention into things that can mess with your mainstream. And then whatever profits that come in, you want to be able to invest in other avenues that are passive, or you want to reinvest into your own business and multiply the assets that you have. Okay, so I think we have enough time to touch on retirement. Now, one of the downfall of being a business owner, whether you're a small business owner, middle or corporation officer, whatever the case may be, most people starting out, when you were an employee, you got enrolled into the company 401k. The old model is this: you have your 401k, you might have some mutual funds, you might have some CDs, you might have some personal savings accounts. And then, of course, back in the day, people lived off of Social Security as part of it. The entrepreneur model, because we no longer have access to the 401k, here's a few things that you do have access to. As you're building your business, the idea is that the business is going to give you dividends and it's going to give you some kind of recurring income, whether in monthly profit, annual profits, whatever, or later if you sell the business and you branch off into investments, you can look at real estate, which is really popular, stocks and bonds. If you are familiar or knowledgeable about that, that is something that a lot of people do look at for retirement. Cash value life insurance is something that I mentioned earlier. And here's the thing to remember about cash value life insurance. You can start just like you're doing monthly contributions into a 401k, you can start on a very small scale to build yourself a life insurance policy for the purpose of retirement. The benefit of having life insurance instead of 401k is, one, it's not a qualified plan. So it's not something that, like, the 401k has tax implications. You put the money in, it grows tax deferred, and later on, when it comes time to take it out, to take your distribution, you are then taxed at whatever the tax rate is in the future. So it's kind of hard to plan because we don't know what the tax rate is going to be. With the life insurance policy, you're putting after-tax money into there. But the cool thing is it grows tax deferred, and the distribution, because it's taken out as a loan, is 100% tax free. There's also no income limitation. So if you're making more than 180,000 as a single, or I think like 215,000, the numbers change every single year. But like there's a cap. If you're making more than that, you can no longer put money into a 401k. With the life insurance policies, there's no limit. So a lot of the major corporations will use life insurance for their like top executives that are making $2, $5, $10, $20 million a year. And they use that as their accumulating retirement plan. Another thing that you have leverage for is, back in the day, they had pensions. So you work for a company for 20, 30, 40 years, and then the company is going to give you some kind of lifetime income stream. You're able to create that for yourself using annuities. And there's a lot of different types of annuities in the market. And of course, for now, you get a few dollars from Social Security. So I went ahead and put it in there. So I threw a ton of information at you guys, and I'm not trying to make you like completely overwhelmed. I'm actually going to give you a handout that gives you an outline of everything I touched upon. But really, the point is, I want you to think about why you started and got into business. What is it that you're looking for? And you can, maybe you quit your job because the hours were terrible, or maybe you have an idea that the marketplace hasn't seen before, and you're like, well, I'm going to be innovative. I'm going to become the next Elon Musk. But whatever the case may be, ultimately, you're in business to make a profit, and that profit is not, I mean, it's not designed just to accumulate in a bank account. It's not about numbers. It's like you're getting into business because you want to build a good lifestyle for you and your family. So if you can take some of these key concepts and some of these principles that I've shared with you and really apply it and start small and start thinking about it like, I have $1,000, I'm going to split it into the different buckets, and I'm just going to create the habit of keeping my money accountable. Because if you can do it on a small scale at $1,000, then you can do it on a larger scale once you're in the hundred thousands and hundred millions of dollars. Okay. So take a screenshot of this. This QR code actually takes you to my calendar. For anybody that's interested, I'm offering a free consultation. I know I went through a ton of information that you probably have questions on. And with the consultation, we can sit down, we can talk about your personal finances, we could talk about your business finances, but ultimately I want to give you answers to your specific set of circumstances. I hope you guys found value in what I had to share, and I'm going to turn it back to you, Julie.
Great. Thank you so much. I also want to let everybody know that we will put all of Marcy's contact information inside of the Slack channel, and it will also be available in Kartra. So you're going to be able to get a hold of her. You'll be able to find her information a couple of different ways. Thank you so much, Marcy. That was fantastic. And stick around because I'm sure that there are going to be some questions for you. And with that, let's flip over to Sean.
Hello, everyone. I just wanted to, first of all, introduce myself and thank Marcy for her overview of cash flow. That was phenomenal. Marcy, I really liked your mention of Robert Kiyosaki and Tony Robbins. And also, one of my favorite people, since we're talking about thought leaders in this area, is Peter Drucker. In my era, when you went to college, you had to read a Peter Drucker book for a management class. And he wrote a book called Managing for Results. But one of his quotes is, entrepreneurs believe that profit is what matters most in a new enterprise, but profit is secondary. Cash flow matters most. And my example of this is I had a client that had a lot of government contracts, and the gentleman was making a profit on them, but he had to wait 120 days to 180 days for his money. So that really affected not only his business, but his personal life. And he had to find a way to manage through that, which he did. A little bit about me. I own a small LLC. I have a bachelor's degree in accounting, a certified internal auditor. And I just want to mention that I'm an enrolled agent, which is similar to a CPA. I'm authorized to represent taxpayers before the IRS when they get into trouble. And I'm authorized, obviously, to file tax returns. And some of my work experience includes working in CPA firms. I worked for billionaire Glenn Taylor, who owned 157 companies when I worked for him. Davisco Foods International, I traveled the US and Canada selling whey protein to various food companies and nutrition companies. And I worked for Wells Fargo, Hormel Foods, and various other companies. And I was a senior vice president at a regional bank here in the Midwest. And I also had a small print shop, which I'll tell a few stories about later. And currently I advise 325 tax clients in 15 states. And I believe in having a proactive approach to cash flow and tax liability management. Oh, by the way, I'm sorry, am I screen sharing right now? My apologies.
No, just looking at your face.
I'm so sorry. Let me get out of this show just a minute here. Sorry about that. Now you can see my screen, I hope.
Yes.
Okay. So that's a little bit about me. And again, as Marcy said, tax liability management is a very important part of managing your cash flow. and that's what I'd like to speak about. First, I want to talk about what a banker thinks of when they think of a formal statement of cash flows. Now, a formal statement of cash flows, like you learn about in accounting class in college, has three components: operating activities, investing activities, and financing activities. The operating activities are the cash effects of the transactions that determine net income. The investing activities involve buying and selling property, plant, and equipment. And the financing activities are all about debt, which Marcy also touched on. And these three components comprise the formal statement of cash flows, which is good, and you can analyze that, but it's less valuable for planning. What I really like to do especially for non-accountants, what really matters is a 12-month profit and loss that shows all the money in and out. At the top, you have all the revenues for each month, and then underneath, you have the expenses broke down by category for each of the 12 months. And you need to prepare a 12-month cash flow. And when profit and loss, I use those terms interchangeably because they're so integrally connected. It needs to correlate with your business plan. This also helps you budget because you're going to use, I like to start a 12-month cash flow with hard numbers and then take it to Marcy's level and change those hard numbers to percentages. And then you can see when you tweak the numbers what happens with the percentages. Now, as a former banker and someone that works with bankers, I know they love to see these 12-month cash flow projections, especially for real estate. They want to see that for every property. Does this property by itself cash flow? And yes, they do want to see your balance sheet with your assets and your liabilities and your income statement that shows, yes, you indeed make a profit. But this 12-month cash flow proves that your thought process covered the contingencies. It highlights your management skills. And a good 12-month cash flow covers every aspect that might happen to you in a 12-month period. Now, I want to talk a little bit about the first step in developing your cash flow is you have to pick a bookkeeping method. And I found that my experience has taught me that if you have 80 transactions a month or less, typically you can just do it in Microsoft Excel or even by hand. If, some businesses are really small and don't write many checks, and you can just do it in a notebook and do a decent job of it. I mean, it's slow for more technically advanced people, but if you're over 80 transactions a month, oftentimes you want to move to QuickBooks. And why are some accountants critical of QuickBooks and other solutions? Well, we see incorrect setups, and fixing the setups takes time. So I would advise you, if you're not comfortable setting up QuickBooks or whatever solution you choose, to get a professional help in setting up the categories, making sure you're booking things correctly, versus people usually contact me and say, hey, my QuickBooks isn't turning out like I'd like. Can you help me with it? And I say, sure. And I go through their transactions and fix them and recategorize them and create new categories and reallocate things between their balance sheet and their income statements so that we can get down to real numbers. Now, a QuickBooks license is typically $12.50 to $35 per month, depending on your needs and whether or not you have payroll. QuickBooks has a standard report called a 12-month profit and loss that works really well for what I'm talking about. And again, if you have under 80 transactions, I recommend downloading a bank detail in Excel and utilizing other free options available. If you want help looking for this, I can certainly provide that or point you in the right direction. Some banks actually have functionality built into their interface to create cash flows and budgets. Not every bank does, but some banks do have this. And just a simple Google of free cash flow Excel templates for examples is a good way to find. You have to find what works for you. I see money, like Marcy pretty much said this, money's a philosophy of life. and you just need to use the tools available to make your life what you want it to be. So I'm going to get now into the steps of developing a cash flow and a budget. And I first want to talk about fixed costs versus variable expenses. It's important to break down your costs into, this is from, sometimes I get a little too technical, so I went to Investopedia just like Marcy did. And they're saying that in variable costs typically are things that vary based upon the output produced. So for instance, labor is often a variable cost. If you own a construction company, the more carpenters that you have, the more roofers you have, the more houses you can build if you're in residential construction, for instance. Fixed costs are typically rent payments, their insurance, and their interest payments. Commissions are also a variable cost. So once you break all these down and you categorize everything, here's an example of a 12-month cash flow. This is on for retired executives have this website, and they're a free resource, by the way. This is on their website. It's a 12-month cash flow, and you can see here cash receipts at the top, and then purchases, payroll, outside services, supplies, repairs. I just gave you a snap of it. You can add categories as you see fit. This is just one example of many that are out there for free. So let's get into the 6 steps. First of all, I want you to remember week 1 of the Academy here, where Rocco said to know and understand your contracts. And you need to know the length of your contract, and then you need to know what is the monthly cost, when does it end, when could it go up, and maintain a repository of all your contracts. Your rental agreement, all of your purchases, your software licenses. That's often one that people struggle with when you have multiple software licenses. When does my license start and end? Amazon Prime, when does it renew? Microsoft, again, when does that renew? And I would keep a spreadsheet that would have the starting and ending dates of all these contracts, and then break that down into monthly and annual on a spreadsheet, and then as Marcy said, again, I'm building on her presentation, have a good handle on what you need personally to survive. Have an owner's draw category or a formal payroll from your business. So if you don't have a formal payroll, every month know what is your break even, and have that as a number on that spreadsheet. And then use all of this to complete the cash flow and budget, and use that information to help yourself to prepare and plan for the future by you can leverage credit cards to a certain point, but at some point, I personally believe that you need a line of credit. A revolving line of credit from a financial institution, once it's approved, cannot be terminated. And as an example, my background includes owning a small commercial print shop. For 4 years, I had 2 printing presses, and my average monthly revenue was about $20,000 at that time. I had 1 full-time employee and 2 part-time. And I had about 400 customers with net 30-day terms. And I found that a $10,000 line of credit at the paper company and a $20,000 line of credit at my bank was sufficient. And it allowed me the flexibility to pay myself and my employees because my income was very variable. Oftentimes, October and November were my biggest months. So I used my cash flow to pay myself and to take advantage of prepayments. For instance, in the printing business, oftentimes you can prepay when there's a buy on paper, you can save 5 to 8% typically. And I wanted to have cash available to do that. Even though I had 30-day terms, I want to take advantage of those deals when they come up to leverage my my business. And the printing business I had operated on a 25 to 30% profit margin. And again, I ran it for 4 years, and then I sold out to a larger company, and they're still doing well today. They have a couple locations. They have one in Las Vegas and one in Atlanta. They're a multi-million-dollar operation. So the reason why I'm talking about this, so on a line of credit, for instance, that $10,000 line of credit had a $100 a year annual renewal. And that renewed every August 1st, I believe. And once you pay the renewal, the bank cannot shut down that $10,000 line. So the problem with the beautiful thing about lines of credit is they can't be taken away from you for the term of the line of credit, which is typically 1 year. Now, with a business credit card line, they can adjust that at any time or shut it off completely. So yes, business credit cards can be good, but I think having a backup line of credit is a great thing as well. And also, only a 45-day notice is required for interest rate increases on most business card credit lines. So that's another reason why, if you lock in a line of credit at 7 to 9%, whatever it might be, typically it's a little higher than the fixed money that's available on, say, a mortgage, your home mortgage, but it's still cheaper than a full-blown credit card that you're running a balance on, which might run as high as 15 to 20%. Now, you want to decide whether this line of credit is secured or unsecured. Unsecured is always typically a higher interest rate. And unsecured, like I said, they typically have lower interest rates than credit cards. And I would view this like insurance. So every year, I like to renew my line of credit, even if I don't use it, just in case I get a business credit card that gets shut off. That could get shut off. I always have this available to me. So these are just things to think about. Again, like I said, money's a philosophy of life, but you can also use your own savings as, in fact, when I worked for Taylor Corporation, Mr. Taylor, a billionaire with 157 companies, he was organized as an S Corp. He had about 35 members, and they always kept a pile of cash, and they self-financed everything. So each of those 157 companies fought for a share of that cash through their budget process to determine who would get $100,000 for a new piece of equipment, or who would get to expand their warehouse and why, and what was the payback on that. These are the decisions that I helped make when I was there. And again, it's flipping back to utilizing the cash flow to create a budget. A question you want to ask yourself is this cash flow realistic and aligned with my goals? And are all the contingencies accounted for? Then copy that cash flow to create a budget, and then you can project it out 1 to 5 years and obtain feedback from Julie and Corey, myself, your experts, and see what they think of it. It's always good to have sounding boards, whoever you trust, maybe a key employee, see what they think of that budget, and then use what if analysis, which is available in Excel. I love this tool, to adjust your numbers by percentages or fixed amounts, know what your cost drivers are and what makes those numbers increase and decrease. This will also help you with planning. And as time passes, you can audit your budget and dial it in and improve it with every year. And then you should take your budget variances and analyze them versus favorable or unfavorable variances, and that will help you to make decisions. This is an example that I just found on Google and this is similar to what I used when I worked for a large company. A couple of large companies had similar to this, budget versus actual with the variance number. And then typically large companies I've worked for like to use 5% or less as a negative unfavorable variance number. If it's over 5%, they need reasons why, and they want action plans on how to solve those problems. So you could use this if you like this sort of thing, or you could build your own. It's not very difficult. So again, I guess I'm talking ahead of myself here, but the Taylor Corporation, it required the 5% unfavorable variance required a detailed explanation for both internal audit and management. And then they wanted an action plan to overcome and improve that immediately. Now, when I was in banking, I was the director of internal audit of a regional bank, and I eventually was the controller of that bank. And it was a $500 million in asset bank with 14 locations at the time I worked for them. They're regulated and scrutinized by OCC bank examiners, and the budget is monitored by internal audit and management, and the unfavorable variances had to be explained to the regulators, and the burden of proof was on the bank to demonstrate financial soundness. And that really made the bank focus on, why are we doing this? Is this making us a profit? Large asset purchases needed to be pre-approved because banking is such a highly regulated industry. They don't want a bank going out and buying another bank if they can't truly afford it and they don't have the wherewithal to do so. So that's just an example. They really were a budget on steroids, the bank was, because of the regulation. Now, you don't need to take it to that level, but I'm just showing you some examples. It's nice when you have budgeting that's tied to your metrics and your goals, and then you can measure your progress. You can tie it to dashboards depending upon, you've got your operational and financial dashboards that you can tie each component to. You can break it up into departments. And I just wanted to mention that I was in sales for almost 5 years, and the sales team really needs to be involved in this process because they need to create realistic sales goals, or if you're a small company, you're wearing that hat. You need to make your own sales goals realistic. And just as an example, when I worked for Nabisco Foods International, which has since been bought out by a larger cooperative, each sales rep was responsible for a percentage of the sales pipeline, and they had constraints. So, for instance, at the time I worked for them, I was responsible for between $7 and $10 million in sales and keeping that pipeline full. Now, that number tied to the amount of cheese and whey coming off the production lines at 4 plants, and those operational numbers were tied to operational budgets, which tied to how many people were on each shift, how much milk is coming in the door, how much we can pay for that milk coming in. All of this was broken down. And of course, it was tied to a number per pound that I'm selling that whey protein product at, which is in many types of food and pharmaceutical and cosmetic ingredients. And my customers were using my number to build their budget to sell their products in grocery stores, pharmacies, cosmetics. And this helps everyone, this kind of structure, especially in a large organization. Now, the other thing I want to mention about cash flow and budget is it proves your scalability, and Marcy really did a nice job of explaining the importance of scalability. That's really why you want to be self-employed, because you want to build something you can scale up. This process of analyzing this and creating this and taking the time, it reveals the constraints and the correlations, and it reveals in the book that Corey and Julie wrote that I just love, they'd like to talk about nice to haves versus need to haves. And you really need to know that in your own business. Page 41 of Seriously Now What says the more liquid you are, the more prepared you are. And Marcy did a nice job of breaking this down as well. You can take this and build a risk management into your process. And again, you can get as detailed as you want. In banking and other industries, they call this a heat map. So risk, the definition of risk is the likelihood of an occurrence times the impact of that occurrence. So this is the total amount of risk exposure. It's the probability of an unfortunate event occurring multiplied by the potential impact or the damage incurred by the event. I got that at CIO.com. So when you're in the process of mapping this out, and again, I have tools for this, or you can find tools online to help you with this. What happens if my sales drop by 20%? What's my plan to cut my expenses? What variable costs can I dial back? Can I renegotiate my fixed costs? What costs am I locked into? That's why I like the process of analyzing all your contractual obligations first, because they're the ones that you're really stuck with. And anything else, know what you can renegotiate. Control what you can, page 169 of Seriously Now What? And then you can take all of this and forecast it and say, what if sales drop 10%? What if sales increase 10%? What if a key supplier suddenly is unavailable and I have to dial back on this product? How am I going to deal with that? Can budgets be too restrictive? Yes, definitely. In my life in accounting, it doesn't matter how large you are. I've worked with $300 million lines of credit, and I've worked with $20,000 lines of credit, and you've always got a limitation on what you can do, how much equipment you can buy, and you need to analyze how does this factor into your target growth rate? What is your capacity in terms of people, processes, plant, equipment, and capital? And how does this fit into your exit strategy? How can buying a new piece of equipment help you to be more efficient? And do you have the budget for that new piece of equipment? I want to talk a little bit about resources. Review your bookkeeping software and look for embedded tools to leverage and utilize. Like I mentioned, QuickBooks earlier, Peachtree, Sage, many other companies have tools that are available to you if you're willing to pay for them, or I highly recommend using a Microsoft Excel spreadsheet. Don't be afraid to ask for professional advice from your team, your accountant, your attorney, banker, your insurance agent, SB PACE, and review your plan every 6 months to a year to adjust and optimize your plan. Please feel free to contact me with specific questions. You can email me or call my personal cell or text me. I'm happy to be a sounding board if you have a question on a specific item. And I would like to offer everyone in the school a 1-hour free consultation. If you would like a second look at your personal tax return or your business tax return, I'm happy to spend an hour with you going through that and seeing, raising questions, looking for things for you to think more about, and helping you in any way that you need help. So with that, I'm going to stop the share right now and turn it back to Corey.
Actually, Julie's going to take it for a hot second. All right. Thank you, Sean. That was really good. And I also I really want to point out that we did not pay Sean in any way, shape, or form for those plugs for our book, but we do appreciate them. I know that Sean has read the entire thing and gone through the workbook. So thank you, Sean, for, I'm not sure that we've ever been quoted before from our book, but I'm pretty excited that we just have been. So that was a nice feeling. Now we have Corey. And before Corey jumps in, I do want to say one thing. You guys, drop your questions in. This is a lot of information that's being covered. Marcy covered a tremendous amount and had a lot of great content. And Sean just covered a whole nother element of finances with respect to your small business. So make sure that if you've got questions, you get them answered. We know historically, Corey and I do, that this is the area where people are most unlikely to ask a question, because there's a lot of embarrassment around the lack of knowledge that most small business owners or people have around their finances. So just know, drop the questions in. We'll keep it private who asked, but this is a really great opportunity to be able to get your questions answered from some experts. So take advantage of it. And with that, take it away, Corey.
Awesome. Thank you, Julie. Give me 1 second. I'm actually, if you haven't noticed, I've got 2 accounts open so I can make sure that I'm recording the correct thing. And I am right now, so that's good. So yeah, thanks, Julie. And thank you, Sean and Marcy. That was, both of those were great. And I appreciate Sean for sure on the cash flows thing. Especially when you're talking about statement of cash flows, that's the most important one in my opinion, if you're going to look at stuff. But I'm not talking about that. I'm talking about ROI and business cases. And so you're just going to get to stare at my face for a little bit while I chat about it, and then I'll jump into my presentation. So Sean and Marcy were talking about how to make yourself, set yourself up, save money, make sure you've got cash coming in, et cetera. Now I'm going to tell you how to spend it, but spend it wisely. So we're going to start with the ROI, which is an acronym for return on investment. And it's a term that most people are familiar with. Everybody's probably heard it. Everybody's probably, there's some other ones out there that, some other ways to call it, but there's a chance that nobody's really actually calculated an ROI. And an ROI can be for anything anything that you're investing in. So it's stocks, bonds, it could be a piece of machinery, it could be a property, whatever. And when you start calculating the ROI, there's a lot of things that you really need to factor in. And that's going to be a part of the business case. So you can have one and the other, but you can't, it's much better if you have the two. When you are doing your measuring, when you're determining what that ROI is, what those values are, you may have to get creative. And that's where we're going to get to when we get into the slides, just how important it is to just think outside the box and just think about all the things that matter when you're making an investment in whatever it is. Why should you perform an ROI? Well, primarily it's just making sure that you're doing something financially sound, but it's also what you might need to prove that you are a sound investment for a bank, to convince your business partners that an improvement, a purchase, a loan, et cetera, makes sense. And like I said, when we were talking about, you got to make sure that you measure everything. You want to start thinking about the fuzzy numbers. And so those are the things that add value, but you can't easily measure. You can measure everything, that's a fact, but you can't easily measure some of these things. So we're going to get into it, but it's things like employee morale or, the cost to replace an employee, things like that. Where there's just a lot of kind of soft costs and basically made up costs that go into them. But most importantly, when you start calculating those in, you're probably going to have to defend them if you're going to, say, take it to a bank. So when you're doing that, don't just make the numbers look good for the sake of making it look good. You don't want to just create all these numbers just to prove to yourself that, pat yourself on the back that you think this is a good decision. You want to get tough in the numbers and, really start thinking about it. Of course, there are some times where, you want to just make yourself look good. I'll take the example of years ago, I was looking for a job in Savannah, Georgia, and I was just walking down the street and I had multiple resumes based upon whatever job they were looking to hire. So you can kind of fudge a little bit, but again, you're probably going to have to defend them, defend all of your assumptions in there. And then, so, make sure that you're conservative enough that it's realistic, but attractive enough that investors will give you your money, because that's essentially what you're looking for in terms of that it makes sense if you are indeed, looking for money. Getting into business cases. First and foremost, you're making the case for why your ROI project, et cetera, is the best course of action. So the ROI is the math for what you want to do. Business cases prove your point. It's the reasoning why you want to do it. So what they do is they help explain your logic. So that's why they kind of go hand in hand. You can have your ROI without a business case, and you can kind of have a business case without an ROI, but they really need to go together. And again, this is for formal business cases, formal ROIs, which I'll get into in a second. But you're going to want to just explain your logic throughout. So anybody should be able to pick up whatever it is you're looking at, and, you know, whatever you're presenting, and understand it without anything, you know, without your input anywhere. And you want to show the pros and cons. Again, you want to make this realistic. So you want to show the benefit of doing something, the benefit of not doing something, that you thought out what, you know, other options, etc. And you want to make sure that, like, ultimately that, again, for you, you're making it realistic in that you're going to make a good decision. Because a lot of this is, you know, we'll talk about gut feelings and stuff like that. And, you know, there is that, but again, like, you want to make sure that it's realistic and that you're not going to, you know, lose money. And if you are, for example, taking this to a bank, or, you know, an investor or whatever, like, you're basically giving the decision maker options, and everybody likes options, but it's really just an illusion of choice. So one of the things that I always tried to train when I was working in restaurants with my servers and bartenders and all that is, like, you know, you've got this menu, there's a dozen different, you know, types of tequila they can buy, or, you know, there's whatever it is. You're going to push them towards the thing that you think that they are most likely going to purchase, and just make them think they made that choice. So it's all about really just saying, okay, here's what I want to do. Here's all these other things. They're not as good. Let's, you know, let's focus on the, you know, the one that I want to work on. Again, these can be formal or informal. So for, you know, most of your small business decisions, you're not even really going to perform one. You might calculate something out in your head. And for a lot of smaller decisions, you don't really need to do this. It's a lot of work for small decisions. We're talking about, you know, the really big ones. Like, again, if you're investing in a piece of machinery, if you're starting a business. So the informal ones could just be, you know, comparing a couple of options. But you could also use this as a way to incentivize employees. So when I was doing some process work, a lot of what I did was basically trying to convince people that they needed to change what they were doing. And for the employees, it's a what's in it for them type of thing. But for, you know, banks or business partners or whoever it is, it's like, are we going to make money? Are we going to lose money, et cetera? And so when I was working with this one company, we would make these calculations and show how they could make money. And in the back of most people's minds, especially the salaried ones, is they knew that they were getting bonused based on profit. So the more that we could do to make the company money, the more that they were probably going to get at the end of the year. And like I said, it's just a case to get people to do what you want them to do. So the business cases that, you know, we've done is we spent a I'm going to get to that later, but I'm going to get to business case hell, which was something that Julie was a part of for one company we worked for. Again, like I said, the formal cases are necessary for investors. So a business plan is just a really long business case. You're just convincing somebody to give you money. When you're writing an entire business plan, I mean, there's so much that goes in there, and you don't really have any other options. Like, you're either starting a business or you're not. But you're doing everything that you can to convince somebody that this is a good idea, and to make sure that, you know, with internally for yourself, that it is a good idea. There's no set format for a business case. You know, there is a calculation for ROI and all of that, but it's really just how you want to present it. So with that said, I am going to hop into my presentation. I believe. There we go. All right. So business cases and ROI. We're going to start with the business case and then work back to the ROI. The parts of the business case, most importantly, you want to define what the problem is. You want to tell whoever's reading this that, you know, what you're trying to fix. So I just created this fake problem to just kind of give you an idea of what the experience is. Sorry, the thing popping up there. So you want to first define the problem. You want to list the benefits. That's the big thing. It's like big picture numbers. We're going to do math later, but, you know, everything that's going to be improved by doing this. And then you want the other basics, like who owns the project, who's impacted, timeline, lifetime of the project, the scope of the project. So the scope is basically what's impacted, and you also want to talk about what's not impacted or what's not going to be included within whatever it is that you're doing. So in this example, we're saying that we need to bring on some salespeople because our sales team's stretched thin, and the scope is the new sales team, and that's going to be an increase in costs and benefits. It doesn't include who's going to play shortstop at the company softball game. Kind of a joke, but whatever. The dependencies, obviously, we need to get sign off by whoever it is, and we need to talk about how critical it is. So as you're prioritizing your opportunities, and we had talked about that a little bit in the process stuff about like prioritizing your gaps and figuring out what it is that you need to fix. This is a part of that, to say, okay, and yes, I was able to tie this into process, but the this is you determining what is like more beneficial to implement than something else. And some things like you just have to do. For instance, if you have like some sort of compliance issue, like you've got to install sprinklers in your warehouse or something like that, that's just a sunk cost, but you'd have to measure, like weigh it against like what the cost of continuing to do business is, or potentially even moving your warehouse to somewhere else, like just, up and loop, selling, moving, ending your lease, whatever it is. So you just got to think about that. And then you also, like I said, want to talk about your options and their benefits and costs. So you don't need to get as deep into those, but you need to say, okay, so if in this example, we aren't going to hire a sales team, we need to get a CSR, or we can outsource it, or we could do nothing, because nothing is always an option. And then you also want to kind of, like I said, you want to think about what happens if you do those other things. And again, you could be as specific or, whatever as you want. You just need to show that you put some sort of thought into it. And as you're making business decisions, like, you should be putting thought into those types of things. And then you're going to have your recommendation. The decisions with the timeline and ownership. So this is for you internally, really, to say, okay, with this particular example, I need to know this by then. And the same would go for an investor or a bank or whatever. Like, I need this money by a certain date, otherwise something's not going to happen. And if it doesn't happen by then, you also need to be able to figure out what that impact would be on your business if it didn't. The ROI calculation. So this goes into the benefits, like into the business case, but you want to list all of your benefits first. So we're looking at the for this, it's going to make an estimate of a current, the current sales team is going to add this much in revenue annually. And then we could advertising costs are going to go up, additional staff support, but we're going to improve morale. We're going to get less stress, better focus. So all of that's kind of in there together. I didn't separate them out, but you want to list everything that's going to increase and everything that's going to decrease. So in like the instance of you want to figure out if you want to buy a new piece of machinery for your warehouse. It might cost you $100,000 and it's going to replace something. There's a salvage value on the old piece of machinery that you need to factor in there. There needs to be maintenance costs, training costs, but you might be able to output whatever it is that you're producing, 50% faster. So you can make up money that way. So these are all the things that you would kind of need to think of when you're talking about benefits and the negatives, which are costs for the ROI. And then you start assigning the values. So some of these are pretty straightforward and pretty standard in terms of, every salesperson has a sales goal of $250,000 a year, 500,000, whatever it is. So you can say that's what our goal is. We can estimate that they're probably not going to do that their first year, but second year, by end of second year, they might. That's pretty easy to measure. The sorry, I'm pulling up this chat right now. Where'd it go? So anyway, you want to start your assumption sheet. So if you're doing this in Excel, which I recommend you do because Excel is amazing, and you can do a lot of calculations in there. And I put in the Kartra site all of like a couple of tools that you could check out when you are trying to figure out Excel if you're not an Excel nerd like myself. But the assumption sheet is basically where you're proving all of these soft costs. So like I said, it's possible to measure everything. And for improved morale, for example, actually, I'm going to go back up. Before we start, before we get into that, and then I'm going to try and find my chat. I don't know where it went. I wanted to, in the chat, if you wouldn't mind, how do you think we could measure morale? And what do you think it is that we need to measure in order to get that number? So what things would go into measuring employee morale? And I'm going to exit this because I think it's hidden over here. And that, there it is. Do we have anybody thinking about what goes into morale? If not, no big deal. I will just tell you ways that you could measure morale. So here we go. In the ROI calculation, this is where we get the fuzzy math, but you can start figuring out different ways that you could make money, lose money, whatever it is, in terms of the assumptions based upon whatever. So in this example of improved morale, I just made up some stuff, but less time spent griping by your current employees. So they're spending a lot of time around the the water cooler, whatever it is, they're spending, you can estimate $10 a month or 10 hours a month you're paying them $50 an hour. So annually that's $6,000.
Hey, Corey.
Yes.
I want to interrupt for one quick second. Sure. First up, we have something to measure morale. Carol has put in employee performance, but I'm wondering if you can just really quick go back one more time and explain to everybody the difference between a hard cost and a soft cost. I'm getting some texts from people who are a little bit confused between the two, and so they can't really actively participate.
Sure, no problem. And anybody on there, there's the, I believe there's the raise hand feature. So if you have a question,
Well, here's the problem though. Most of the people don't, what I'm also getting is that people don't want to ask questions because they're embarrassed about their lack of knowledge where they're at. So we're going to have a little bit of a different conversation when you're done to kind of bring more people up to speed.
Sure, sure. No problem. And if anybody is embarrassed, just say, have Julie ask it, and Julie can, we'll just say, Julie wanted to know what the difference between hard and soft costs are.
Yes.
So your hard costs and your the hard benefits are the things that you can definitively measure. So I made $500,000 last year selling, stocks and bonds is something that I can easily measure. Like you can't dispute it. Nobody can really, it's the 2 + 2 = 4. I know there's like some crazy math calculation out there that proves that 2 + 2 actually isn't 4, but for all intents and purposes, it's what is definitive that nobody can argue. When you get into the soft numbers, it's the stuff that just like I call it fuzzy, but it's just they're a little harder to track. So employee morale is like the one that's I like to talk about, because happier employees, in theory, will produce more for you. They'll, they can help reduce costs. They can, increase revenue, whatever it is. There's a lot of things that happier employees will do, and there's a lot of things that unhappy employees will do. So you're going to start talking about theft, or, like time theft is a thing. People missing work, so loss of productivity, things like that. You can't really measure, like if I'm unhappy and I just call out sick tomorrow because I'd rather go, fishing or whatever. Yes, you could probably say, all right, well, he normally produces this much a year and we'll just subtract a day. And that's one way to calculate it. But somebody's probably going to pick up my slack there. So that means that, like if you take the, whatever I produce per year divided by 365, you're like, okay, that's the number. That's a good starting point, but somebody might pick up some of the slack of that 365th number. So it's not quite that. So that's the difference between the hard and the soft numbers. Julie, did I explain that very well enough?
You did.
Okay.
I'm just getting texts that it now makes sense. So thank you. And we're starting to get some questions into the Q&A. So we'll save those for when everybody's done, but this is good. Yes, thank you.
Perfect. Yes, Julie, you were quote unquote getting texts. You're welcome for the explanation.
That's true. I don't know the difference between a hard and soft cost.
Yes. Yeah, no, just blame Julie. But again, that's what this slide is here. It's in this number up here, we said the improved morale is going to save us $30,000 a year in this fake business that I'm in. And here's how I got to that $30,000. So it's the less time spent griping, more time spent on clients, because we have now more people working, which means that all of the other stuff all the stuff that's happening that's not value add is now split across more people, so that the existing salespeople can potentially make more sales per month. We're going to throw in a cost avoidance right there. So let's say we don't bring in new salespeople. We're guesstimating that we might lose somebody within the next 6 to 12 months. So what's the cost to replace that one sales member? So the cost would be $500 for advertising, however much you want to associate your time for doing interviews, and then potential loss of clients. They steal your clients and go to wherever that salesperson went. And then winning the bet on the company softball game. So it turns out that one of the guys we're hiring is a ringer, and he's going to play shortstop for us. And that's one of the primary reasons that we're hiring him. And so I'm going to win that bet. So again, these are all in my made up scenario, even, these numbers are definitely made up, but in all of the business cases, when you're talking about soft costs, you're making up these numbers. You just want to make sure that you can justify them reasonably, not only to yourself to make yourself feel better, but for anybody who might be looking at it. And like I said, one of the big takeaways there, cost avoidance is a benefit. Now, the easy math, you want to take all of the benefits minus your costs and then just divide it by the costs. I probably should have put that calculation on here, but that's all that the ROI is. So if you're planning on, you're going to make $500,000 and the cost is $250, and then you divide that by the $250, you're going to get, 100% on the ROI. A lot of times though, that ROI isn't going to, your initial cost or your initial savings and increase in revenue won't be more than what the initial cost is. So for instance, on that, you're buying that piece of machinery for your warehouse, you might save or make an extra $20,000 in year one. That piece of machinery cost you $100,000. And then, so without anything else put in there, but you're going to make an extra 20 grand every year, you still have a positive ROI, assuming that the lifetime of that piece of machinery is greater than the 5 years, or is greater than 5 years. But if you're saving or making an extra 20,000 every single year, at year 5, you will have paid for your investment. And then everything beyond that is icing on the cake. So if it has a lifetime of 10 years, that's an extra $100,000 that you get. So you want to figure out when you're going to pay it back. And this is something that you would need to do if you're, let's say, going to a bank, I don't know how detailed they'll get, but if you come in with numbers like this, you're probably going to be more likely to get a loan than you wouldn't. Sean, since he worked in a bank, might be able to say different, but we'll get into that afterwards. But you want to put what that actual ROI is. So it's, total costs, total benefits. Here's what my ROI is. And then here's how long it's going to take to pay back whatever my investment is. So don't forget to include that in your business case. And like I said, you obviously want to have that assumption sheet. So that's it on that. I got a couple of follow-ups, just big items that I want to cover, just to make sure that I'm driving home some of this stuff. So a lot of the decisions are made using your gut instinct, And oftentimes your gut instinct is correct. And it's called a gut instinct for a reason, because you're in your business, you know your business. You don't need to sit down and, hash out all of the numbers to make that decision. You know that if you do this, you're just going to improve your business. That's great. But you should just do it when you are approaching bigger decisions, more expensive decisions. And obviously when you need to prove a point to somebody like a banker, an investor, or your business partner. But you also might need to use it just to justify your decision to the employees. So let's say that piece of machinery costs $1 million now, and you're going to save $20,000 a year, make an extra $20,000 a year. That's now going to take you significantly longer to pay it back, and that machine will probably be obsolete by the time you get that. So you could take that to your employees and say, here's the reasoning why. I mean, you want to be transparent. You don't have to throw all the numbers out there, but you can go to them with a straight face and say, it doesn't make financial sense. I'm sorry. I want to iterate again that cost avoidance is a benefit. So that's something that a lot of people don't factor in when you are, again, like factoring in, okay, I'm only going to make an extra $5,000 a year, but what are you saving? What are you not spending? So cost avoidance is a benefit. And like I said, don't write it just to make yourself feel better. Like you're going to have hard conversations with yourself, bring other people in, call Sean or Marcy and say, hey, does this make sense? Because you want that input and feedback. Like you want to know, like, does this make sense? And is this a good idea? You might think it's a great idea, but it might not. And then again, be realistic. So funny story to round out my conversation, and we'll jump into questions. So business case hell. This was a month or two for a company that Julie and I worked for, and we were working. It's a large company, and they were implementing a new computer system for the company, a new ERP, but which is just the computer system that everything kind of functions off of. And it was a disaster. It was a mess. And like right towards the end of the project, we were brought in, like the business team was brought in to analyze this, and it was a mess. And they're like, well, why? So we started telling them. Then we spent probably like a month and a half writing business cases for all of the changes, like the change requests that we needed in order to make this system functional for the warehouses out in the country. And we got questioned a lot on, as to, like, why do we need this? Why do we need this? And ultimately it was just like, this computer system sucks. Like I've written, I don't know how many business cases to tell you. Like, I think I wrote like 18 business cases just for my one area. I have no idea how many of the other people in my group did, to just tell the company that it sucks. And ultimately, we did a pretty good job of tanking that, and that did not get implemented. So funny story there. Millions of dollars lost because they didn't bother to do a business case ahead of time. So that said, that's all I got. Julie, do you want to handle questions?
I would love to handle questions. Yes, I would. So I'm going to take can we put all four panelists with their faces in the grid? Yeah. Okay. Let me change to gallery view. All right. Give me a thumbs up in the chat if you can see everybody. Okay. Well, I can see. Well, I know you can see everybody. I'm asking the people, the attendees.
No, I've got myself logged in over there as well.
Okay. So thanks, Nicole. All right. So Corey, this question is for you. Are ROIs used after you decide to go for the item wanted and compare how your estimate versus what the real cost benefit was to see how close your estimate was for the item? So is that why you would use an ROI?
No, using the ROIs to justify your decision. So if you need to buy the new piece of machinery or whatever, you want to figure out, does it make sense to even purchase that machinery, hire that employee, whatever. It's you doing the math to justify your decision. I hope that answered that.
I think that answered it. Hopefully it answered it for the person asking the question. Shoot a comment to the panelists if that did not answer the question. What I would like to do is So this was a lot of information, and I think we left some people feeling pretty overwhelmed. If my phone is any indication, we've got some people feeling overwhelmed. So I thought maybe it might be a good idea to circle back and just cover at a very basic level, like the top 2 or 3 takeaways from each of you guys' section. And also lots of questions on there was, because this is finance, there are a ton of acronyms that get thrown out. And y'all use the acronyms every single day in what you do, but the attendees were really unfamiliar with a lot of the acronyms. So to cover those again would be absolutely fantastic. And I know Marcy has a presentation or has a document that she's going to be sharing with everybody. Sean, I don't know if you may have said it and I missed it. If you have something you're going to be sharing.
I shared my PowerPoint on the website. So.
Okay, perfect. And Corey has his presentation that he'll also be sharing. So when we send out the week 3 recap within like the next 24 hours, all of that stuff will be available. And I strongly encourage each of you, if you have questions, if you are confused, reach out to Marcy and Sean. They are experts. They are super easy to work with. If you have, obviously I'm going to say to reach out to you. If you have questions on business cases or ROI, then you definitely want to reach out to Corey. And, listen, full disclosure, Corey still has to do my business cases because I don't know how to do them. So nobody on here should feel less than because you don't understand how to do them, because they're complicated. And I may have cried a few times over them in my past, but that's in my past. So, all right. So Marcy, you want to give some like top 2, 3, 4, whatever takeaways that are just very basic for everybody so they can kind of get a good idea of what to do?
I think the most important thing with financial planning is first to identify what things cost, kind of like what Sean was saying about you have a baseline cost. And I think I referred to that exact terminology too, of like, how much does it cost for me to live? How much is my food? How much is my shelter? How much is my car? And then you look at the business side and you go, how much does it cost to operate? If you're online, then you have hosting, you might have to pay for an email, you might have like software you have to pay for. If you have a physical location, then obviously you have rent, you might have employees. So if you can start off knowing what things cost and you can figure out, okay, I'm selling widgets for $100 a piece and it costs me $10,000 to operate, then I need to sell X number of widgets in order for me to not only pay Uncle Sam, but also to cover my baseline. And holding your money accountable. And it's really like, it's developing a habit. If you are familiar with T. Harv Eker in what is the book called? The Secrets of the Millionaire Mind. He talks about the buckets and he says, if you don't have the percentages to do 50% into your living and operating expense, and then all the other percentages that I mentioned, you start off with setting each bucket. So you have a tax bucket. Every single dollar that comes in, 30 cents goes into that tax bucket, 15 cents goes into the tax bucket, whatever allocation, and you become like religious about putting it into that bucket. Then you pay yourself, you take 10% and you put it into the other bucket. And once the buckets are there, then you're only looking at that bucket and you're like, okay, this is how much I have to pay for my stuff here. This is how much I have to pay for my stuff here. This is how much I have to pay for my stuff here. And it becomes a process and nobody expects you to figure it out yourself. That's why there are financial professionals to help you walk through it. And I want to expose you guys to that concept, because if you don't start small where you're at now, then when you get really big, and let's say, everyone says save 10%, saving 10% of $100 is a lot easier to develop the habit than saving 10% of $100 million.
Thanks, Marcy.
That's as basic as I can make it.
That's great. That's great. All right. Sean, how about you?
Well, first, one thing I struggle with my tax clients is I use the term revenue, income, and sales interchangeably. People in accounting tend to do that. But what I mean by revenue, sales, income is whatever cash you're bringing in, it's all about cash in and cash out. So know how much cash you have coming in and know how much you have coming out and track that and have a system to, write it down. Or I help people with their checkbooks sometimes that sometimes people come to me and they say, I don't know why I cannot pay all of my expenses for the month. And I help them go through their checkbook and say, okay, this is how much you have coming in from your job or Social Security or whatever it might be. And then you've got your rent, you've got food. I'm breaking this down in a personal level, which correlates to business. So let me know if there are specific terms that I used that you didn't understand, and I'll use a different term to explain it.
Yeah, and I think that everything that we said today, like Julie said at the beginning, this is a lot of information. We have, this video will be posted out there tomorrow. And it'll be broken up by sections. So if you want to go, walk through it again. And for me, I'm terrible at asking questions like right after I absorb something. Like I need time to digest it. And then, 24, 40 hours, I'm like, oh, I should ask this question. So, you've got our contact info, reach out to us. For me, it's all about just being realistic and just measuring things. And it seems ridiculous when, you're trying to measure something intangible like employee morale. But again, you just factor in everything that you can think of. There's a book if you're interested in learning how to be better at measuring stuff, or if you just need something to put you to sleep at night. But it's a really good book. It's called How to Measure Everything by Douglas Hubbard. If you are interested in learning how to literally measure everything, I suggest that one.
Yes, if you would like to turn into a mini Corey, then buy that book. I have that book too. It actually is really good. Very informative. I would also say
Can I add one more thing? I'm so sorry.
No, go ahead.
A shift in the mindset. I know that finance is a huge topic. Like I said in the chat, it's like you're out in the ocean, and if you don't have a navigation, if you don't have a system in place, you're going to get taken over by the waves. But as you approach finance, as you approach anything in life, you want to take your mindset to a point of like, what do I want? If you can define what the end result it is, whether it's in your relationship and your finance and your health, if you are clear about what is the end result that I want, then you can start asking your questions of like, how do I get from where I'm at to where I'm going? And I think a lot of people, finance is such a taboo topic that we've grown up not talking about. So once you immerse yourself into business, it's easy to talk about all these different fancy terms, social media marketing and this and that. But then you talk about like basic financial concepts we've never been exposed to. I don't even know where to start. And you think about like, okay, the end result that I want is I want to be comfortable. I want to be safe. I want to have some level of security, and I want control over my financial future. Then you can answer in backwards, looking at it and say, okay, I'm here now. I'm currently not comfortable. How do I become comfortable? I'm currently not secure. How do I become secure? What would have to happen for me to feel this way? I hope that helps.
That does help. Sean, you have anything you want to add?
Well, I wanted to add, when I use the term variance, I simply mean, is it positive money or negative money? And when I say unfavorable variance, that just means that whatever expense you're tracking is not going the direction you thought it was going to go, and knowing why numbers move the way they do, tracking that down really helps you to run your business. And if you don't personally feel comfortable doing that, there are so many people. There are people that basically fly by the seat of their pants. They're very entrepreneurial people, and they have in-house accountants or people like me they hire to tell them, hey, I have construction people that call me and say, do you think I can afford to buy a Bobcat this year? Or, a new truck, whatever it is. And I do some analysis and I give an opinion. There may be many other factors other than financial factors in that decision, like efficiency, for instance. And that's kind of what Corey was getting at with ROI. There's more to a decision than money. There's time is money. Let's not forget that. I'm kind of rambling here, but that's all I wanted to add.
I think that's great. That's great insight. And it's kind of funny because I just think, Sean, I can think of so many instances where, you know, Corey and or I have like texted you or emailed you or gotten on a Zoom with you because we're like, hey, how do we handle this? And most things, you know, I think people come with this notion that as small business owners, they're just supposed to know everything, right? And as an example of this is our most recent example. This is a very real world example for us. Corey and I are entering into a collaboration with somebody, a friend of ours, where we're going to be creating a product together and selling it. And we're like, we got to get on the phone with Sean because we need to understand what the best process is for like paying out the funds to the other person, because we're going to be collecting all the revenues, and like, what does that look like? And this isn't stuff that we're supposed to know, right? We're out there helping people, but this isn't our area of expertise, and we're never going to pretend that it is on the finance side. And I think that's really something that everybody just needs to get really comfortable knowing, that you don't have to be an expert on everything, but you do have to know you should be an expert on when you need to ask someone for help. It's really, yeah.
Yeah. And I mean, like with Sean, like we're going to walk through this thing. Like I have an idea of how I think it might work, but again, like that's all I have. Like there's no way that I'm going to take my process and actually, you know, present it to Uncle Sam next year. So, you know, that's where Sean's expertise comes in. But I mean, everything like he's going to walk us through that, and I'm going to get a little bit of knowledge. Julie's probably going to black out for most of the conversation, but you know, that's just our partnership here with our business. But again, like talk to your accountant, call Marcy, call Sean, call me and say, hey, can you walk through this particular thing? Can you show me how you did this? I'll put some examples out there for mine that you can use. And it is simple. The hard part is like making up all of the numbers. But if you read that book, you can make up anything.
And if ever there was a week to take advantage of the Slack channel, whether it be dumping questions into week 3 or doing a private chat with Sean or Marcy or Corey, take advantage of it. And I like to always remind people of this. If you have a question, chances are almost 100% that someone else in the group has the same question. And so ask. There are no stupid questions. There are stupid people, but there are no, just kidding. There are no stupid questions. Just ask. These guys are experts, all 3 of them, and they are here to help, and they are glad to help. They're happy to help, and they're easy to work with. Like we would not have put them on this panel if they weren't. So and yeah, if you're too embarrassed, send the questions to me. I will ask them, and I will say that it's me that needs to know, because I have no shame. I think everybody knows there are a lot of things I don't know. So, all right. Is there any final questions or comments from any final comments from the panel?
I want to thank you, Corey and Julie, for putting this together. I am learning along with everybody else, and I think this was a great opportunity to really clarify things. So thank you.
Oh, thank you. Thank you for being a speaker, and thank you, Sean.
I'm grateful also. I really enjoyed this, and I like talking about cash flow, and it made me realize that I probably could have made it simpler, but I just wanted to cover the topic thoroughly, and it's a lot of information, like you say. There are several approaches to every challenge, so one solution might not work for everyone.
Yeah, that's true. And I do want to just say one more thing, that as I really am sincerely getting text messages, you guys. I think Corey thinks I'm making that up, but I really am getting them. And I did get a text message that said, this was amazing. This session was amazing. So kudos to you guys for presenting and for giving some really great information. And I have no doubt that there will be people reaching out after this week, because this was some big stuff and it's important for your business. Thank you, everybody.
Yep. Thanks, y'all.
All right. Thank you.
Bye.